from Heartland, and I'm in New York City, Lower Manhattan to be more precise, not far from Wall Street, New York Stock Exchange. Off behind me, can't really make it out, but that's the Statue of Liberty. Beautiful structure. What I was hoping to show was Governor's Island, but I can't get to because of a lot of construction that's going on. And I wanted to show that because May of 1624, so just over 400 years ago, is when the Dutch landed there and ultimately created New Amsterdam. And not that that was a monumental market moment, certainly notable for sure from a historical standpoint for Manhattan, New York, United States, etc. We're trying to incorporate how we think about history in our portfolio construction, and security selection work. Having that context is really important. There's an old saying on Wall Street, or a dangerous saying, that this time is different. And we take the view that history might not repeat itself, but it tends to rhyme. So having that perspective from a historical standpoint can be a huge value add. And I think that really comes to life when we think about valuation. That's one of our 10 principles of value investing. We'll incorporate some of our other 10 principles: price to earnings ratios, price to cash flow, price to book, in that work. Other multiples too that are most applicable to the business: enterprise value to sales, or enterprise value to EBITDA, sum of parts, and net asset value. But we'll look at the business and understand what's the most applicable valuation metric and come up with upside targets and downside targets. So in the case of a bank, price to tangible book value is probably the most relevant. That multiple, though, doesn't make sense for, say, a software company. So we'll look at it from an enterprise value to sales standpoint. But getting back to history, how bad or how low did valuation go, for instance, for any business in a recession? You think about COVID, you think about the great financial crisis, you think about the dot-com bust, you think back to the early 90s, or even further, we can look back and see where a business ultimately troughed out on the most appropriate valuation metric and weave that into our max downside loss analysis to really understand the broader risk reward. We want to think about the upside and the downside to have a more holistic view of the opportunity set across our portfolio, and we think that's a key component to producing consistent investment results for our clients. Thanks for watching. I hope you're having a great spring, and I look forward to updating you more this summer. Take care.